Guys, Mark Parsons here from Remax. Today I just wanted to go through how to analyze a real estate cash flow on a residential property. So as you'll see here, we've got cash flow analysis. This is an Excel worksheet that I'm more than happy to share with you for free. If you're interested, just message me. It is much more comprehensive than just a cash flow analysis. It also includes acquisition costs, property purchase costs, meaning the one-time purchases such as home inspection and things like that are just part of the purchase. And it also calculates your ROI and mortgage pay down. So if you're interested in that, message me, I'll get it to you. Today, we're just going to focus on the section of cash flow analysis. So in this, to make numbers easy here in this is just a fictitious example. Property, we'll say we have $2,000 a month rent. In this spreadsheet, you just fill in the blue sections and everything else will calculate for you. Now, less vacancy provision, I always like to account for potential vacancies and be putting money aside for that for the times when it does come up. Now, typically I would just use the city's average vacancy rate. However, in the lower mainland right now, vacancy rates are so low, some are even below 1%. So we'll put it in at 3% there. Once again, the numbers calculate up. Then you have your rent less your vacancy provision, which gives you your net rent. So now we get into expenses. You may have advertising costs to get the property rented. Now, typically this will just be a one-time cost, so you'll enter it there. Now, in the Vancouver market, because we have Craigslist and it's so active and the city uses it, especially for rentals, you will likely have zero advertising cost to get your rents, assuming that your place shows and is priced right. Next, we have strata costs. If you're dealing with a townhome or a condo or any sort of detached home on a bare land strata, those are far less likely. So condo or townhome, you're going to have a strata fee, and type it in, it will calculate it up there. Property tax, you take your annual property tax, it will divide it monthly for you there, so you know your costs and you can account for it. For property taxes, that's public information. You can always get your realtor to get that for you as well. Now, you're going to want to have insurance on your property. Another thing, you want to make sure that you do get your tenant to get content insurance, so that if something were to happen when you insure a building or a unit or a home, it's not covering your furniture, your clothes, everything like this. You never know what will happen. You want to make it mandatory in your lease with your tenant that they have to get content insurance and show you proof of it. Otherwise, if something were to happen, this could be the case if you're in a condo, the person above them has a huge leak while everybody's at work. That water comes down, damages your unit and damages your tenant's stuff. You will be covered for your unit based on your strata insurance, but you would not be covered if your tenant's stuff was damaged. And they would come back. I'm not sure exactly how that would go, but that's not what you want to be involved in. You want things as smooth as possible. So in your lease, make sure it is written in there that your tenant must have content insurance and that they show proof of it, and that will avoid that. Next, we have repairs and maintenance. Now, you never know what's going to come up, but stuff will come up. So again, this is one where you type in a percentage of your rent and then just let a little bank account build up money over the year, because things will come up. This is changing light bulbs, fixing toilets, changing handles, whatever it may be that comes up, kind of wear and tear of the property. So in this case, we'll just put 4% there. 4% of rent a month is probably, it's a good little buffer there. Property management, if you're not managing it yourself, you're going to have property management costs. Now, typically you can get it for about, between 8 to 10%, sometimes 8 to 12%. Really depends on the area, the tenant profile, how many properties you have with the property management company, but say 8 to 12%. Some do have a flat fee, so you can talk to the property management companies out there. For simplification of this video, we will just go with 10%. So from 2,000, 10% would be 200, calculates it up. And then there's a spot for other expenses, because every property will be unique and may have other expenses that occur. So now we also have caretaker here. Another thing I did want to mention, I mean, if you have a single family home and you're paying someone to come and do the yard for them, then that could be a cost there. But it is also very common to have in the lease that the tenant will care for the property, meaning do the mowing of the lawn and everything that comes along with that. Usually how the relationship will go is that the landlord provides the lawnmower, the weed whacker, whatever it may be, and it's written in the lease that the tenant will use that and upkeep the property. Of course, if there are any repairs or maintenance for that equipment, that would be on the landlord's responsibility, and that's why we have repairs and maintenance there. So you add all those up, you get your total operating expenses. So with the cash flow, we've got our rent, less vacancies to bring us to our net rent. Then we've added up all of our monthly expenses to our operating costs, and then we take our net rent minus our operating expenses, and that leaves us with our net operating income. After that, you've got your mortgage payment. Now, our mortgage payment is based on a 25-year amortization at 3.74%. Now, this number is always going to be changing. It will depend on the mortgage that would be available to you and the interest rate that would be available. I mean, amortizations for mortgages, I believe this is always changing, but can go up to 35 years. At one point it was up to 40 years there, but they've taken some products off of the market, and interest rates are moving. Maybe you can get better, maybe it's worse, depending on when you're watching this video here. So you got your net operating income, you take away your mortgage payment, and then you have your net cash flow. Now, you're only seeing the cash flow analysis part of this property analyzer. So it's showing your net cash flow here, and then it says net income with principal reduction. Because if we scroll down here, I'm not going to get into this in this video, but it calculates all of your principal reduction, which is something that is often overlooked when people are looking at their doing their cash flow analysis, not taking into account the principal reduction, which is something that happens every single month. A portion of your payment is going to go directly into your mortgage. It's a forced savings. It is part of the overall numbers of your cash flow analysis, even if it's cash that is stuck in the property. I like to make sure I look at both numbers, so I see the net cash flow. This would be how the actual bank account would operate, with this money going in and this money coming out, but how the property is performing from an investment standpoint of yours. You would also want to include the principal reduction, because if we were talking about your actual net worth, or looking at this property as a whole as an asset, you would need to include in those numbers, or you should include in those numbers, a principal reduction, because that's real money that's going into your pocket, even though you can't withdraw it out of the bank prior to selling the property. So anyway, that's it. That's a cash flow analysis. Like I said, if you want a copy of this property analyzer, let me know. I'll back it up here so you can see it. It has your acquisition and mortgage costs all calculated in. You just type in the blue and it will fill in the rest. It's got your purchase costs, so the one-time purchase costs of the property, calculating your property transfer tax, what we went over here, the cash flow analysis, and then you can also enter estimated property appreciations, and it will calculate that for you, as well as your principal reduction, your mortgage pay down, and at the very bottom, what we're all looking for, the return on investment with appreciation and principal reduction. So that's all for that. If you have any questions at all or would like a copy of this, let me know. If you're thinking of buying or selling real estate, I'd love to chat with you. If I can help in any way, that's what I'm here for. Mark Parsons at Remax, 604-808-1827. You can probably see my number somewhere around this video. Thanks a lot.